Hello everyone. In this video we're going to continue the discussion for chapter 4, which is about the accounting cycle, and we're going to see an example that would take us through the entire accounting cycle. So the complete accounting cycle for one period would be explained using an example for someone called Kelly Pitney. So Kelly Pitney has operated a part-time consulting business from her home. Starting, or as of April 1st, year 8, Kelly decided to move to rented quarters and to operate the business on a full-time basis. The first step in the accounting cycle is to analyze and record transactions in the journal using the double entry accounting system. So transactions are analyzed and journalized as follows. So in the first step, we carefully read the description of the transaction to determine whether an asset, liability, common stock, retained earnings, dividends, revenues, expenses, any of these accounts is affected. And then in the second step, for each account affected by the transaction, we determine whether the account increases or decreases. And based on that, we are going to decide which one goes debit and which one goes credit. And then in the fourth step, we record the transactions using a journal entry. So the company chart of accounts is very useful in determining which accounts are affected by the transaction. Remember, the chart of accounts is the list of accounts available for that specific business. It varies from one company to another. It's not something that's standardized in all businesses. The terminologies are the same. So for example, all companies use the term cash to refer to the money owned by the business. Accounts receivable, which is promises from our customers or clients to pay us in the near future, and so on. So here we have a list of the accounts based on the chart of accounts for Kelly Consulting Business, and you can see here all the assets. They start with the code 1, and they have this listing 1, 2, 4, 5, 6, 8, and 9, and then all liabilities start with the code 2. Equity starts with the code 3, revenues 4, and then all the expenses 5. So usually a business would record all the transactions in the journal, and here we have a list of transactions that took place during the month of April, and you can see, like, if I look at this transaction, I can tell you that there was cash brought to the business, there were promises from customers to be collected, supplies brought to the business, and office equipment, and in the credit we had common stock that was brought to the business by Kelly. Kelly paid for the business some rent in advance, so that was a prepaid rent, which is an asset, and she credited cash, and so on. So these are all the transactions that we covered in chapter 1 and 2, but of course using the journal entry technique, which is the accounting way of presenting transactions. So here we have like 3 pages of the journal that goes all the way to April 30th. Periodically, the transactions recorded in the journal are posted to the accounts in the ledger, and this is what we call it the posting process. So the debits and credits for each journal entry are posted to the accounts in the order in which they occur in the journal. So journal entries are posted to the accounts using the following steps. The first step, the date is entered to the date column of the account, and then the amount is entered, whether it's debit or credit column. Then the journal page number is entered in the posting reference column. And then finally the account number is entered in the posting reference column in the journal to confirm that this transaction has been posted already. So the journal entries for Kelly Consulting have been posted in the ledger, and we have like Exhibit 18 that shows this in the book. An unadjusted trial balance is then prepared to determine whether any errors have been made in posting the debits and credits to the ledger. The unadjusted trial balance, shown in Exhibit 11 again in the book, and we're going to see it in the next slide, does not provide a complete proof of the accuracy of the ledger. It indicates only that the debits and credits are equal. So it actually helps in detecting any kind of mathematical errors, but it's not like 100% proof that everything is accurate in the ledger. Because if we recorded a transaction in a wrong account, this is not going to appear on the trial balance as an error. So this proof of value, however, because errors often affect the quality of debits and credits. the two totals of a trial balance are not equal, an error has occurred that must be discovered and corrected. And normally, if we find that the debit and credit are not balancing, then we have to go back and check where is this problem coming from. And here we have an example for the unadjusted trial balance for Kelly, and you see here all the list of the accounts, starting with cash, all the way to miscellaneous expense. So we have the assets, liabilities, equity, revenues, and expense. And you can see here all the debit column and the credit column and their totals are matching. So before the financial statements can be prepared, the accounts must be updated. The four types of accounts that normally require adjustments include accrued revenues, accrued expenses, unearned revenues, and prepaid expenses. In addition, depreciation expense must be recorded for fixed assets other than land. And this is typically what we've done in Chapter 3, which are the adjusting entries, the 5 different types of adjusting entries that we've seen. So for Kelly on April 30th, they went through this kind of adjustments. I'm not going to go into details, but just to give you an example, here we have insurance expired, we have supplies leftovers that can help us decide how much are the supplies used, the amount of depreciation of office equipment, the accrued salaries for the receptionist, rent that expired or used, and then the unearned fees at the end of the year, which is the amount of fees that we received in advance from our client, can help us decide how much fees we actually earned. So once this is done, we can prepare the optional end of period spreadsheet. So although an end of period spreadsheet is not required, it's useful in showing the flow of accounting information from the unadjusted trial balance to the adjusted trial balance. In addition, an end of period spreadsheet is useful in analyzing the impact of proposed adjustments on the financial statements. Again, the appendix will give you a better explanation for how you can prepare the adjusted trial balance using the Excel sheet. But again, for the purpose of this course, I think this is totally optional. So I'm leaving this for you to decide whether you want to understand it or not. But you're not going to get tested on it. And here's an example of an Excel sheet that shows the unadjusted trial balance, the adjustments, and then finally the adjusted trial balance. It's very easy, it's not that difficult to implement, but again, for the sake of this class, I'm just going to keep it optional for you. The next step is journalizing and posting adjusting entries. So based on the adjustments data shown in the previous step, adjusting entries for Kelly Consulting are prepared in Exhibit 13, which will be shown in the coming slide. Each adjusting entry affects at least one income statement account and one balance sheet account, and remember, it has to be at the end of the period, and cash is never an account in an adjusting entry. So remember, cash is never involved because in adjusting entries, there are no real cash transactions taking place. So explanations for each adjustments, including any computations, are normally included with each adjusting entry. So each of the adjusting entries shown is posted to Kelly Consulting's ledger in Exhibit 18 later. And then the adjusting entries are identified in the ledger as adjusting. And here we have an example for adjusting entries. So you can see that each one affects an income statement account and a balance sheet account. So here we have an adjustment for the insurance, adjustment for the supplies, depreciation for the salaries, the rent, and for the unearned fees that were partially earned. So after the adjustments have been journalized and posted, an adjusting trial balance is prepared to verify the equality of the totals of the debit and credit balance. And this is considered to be the second form of trial balance. This is the last step before preparing the financial statements. So now we're ready to prepare our financial statements, starting with the income statement, statement of stockholders' equity, and then the balance sheet. If the adjusted trial balance does not balance, then we have an error and must be found before we prepare the financial statements. The adjusted trial balance for Kelly Consulting is in the next slide. So here we have an example for the adjusted trial balance. And again, it has the list of all the accounts, the debits and credits, and this is the one that's going to be used for preparing the financial statements. So the next step, step 8, would be preparing the financial statement. This is considered to be an important step because an important outcome of the accounting cycle is the financial statement. The income statement is prepared first, followed by the statement of stockholders' equity, and then the balance sheet. This order is required. You cannot follow a different order. You cannot start with the balance sheet because you need the stockholders' equity section from the stockholders' equity statement. And again, to prepare the statement of stockholders' equity, you need the net income, which is, there's no way you can get it until you prepare the income statement. So the statement can be prepared directly from the adjusted trial balance, the end of period spreadsheet, or the ledger. The net income or net loss shown on the income statement is reported on the statement of stockholders' equity along with any dividends. Then the ending retained earnings is reported on the balance sheet with common stock as part of the stockholders' equity. Finally, stockholders' equity is then added with total liabilities to equal total assets. And that's how typically the balance sheet would look like. So here we have the example for income statement, and remember that's for the month ended April 30th, year 8. And we start with the revenues, we list all the expenses, get their total, get the difference, and that would be our net income. And then we have the statement for stockholders' equity. Again, the same thing for the month ended, April 30, year 8. We'll have a column for common stock, retained earnings, and the total. And then we start with the beginning balance. We have the common stock, the net income, we subtract the dividends to get the amount of the balance for the end of the year, or end of the period. In this case, it's April 30th. Then the balance sheet consisting of assets, liabilities, and equity. And remember, assets are divided into current assets and property, plant, and equipment. One thing I want to remember that accumulated depreciation is typically shown under assets, but it's going to be deducted from its related assets. So here in this case we have office equipment for $14,500. We subtract from it the accumulated depreciation for $330, and the balance for the office equipment would be $14,170, which is the only property, plant, and equipment in this case. Then we have a list of liabilities, and then a list of stockholders' equity, including common stock and retained earnings. Then we add the liabilities and the stockholders' equity total to get the total here, which should match the total assets. The last step is to journalize and post the closing entries. So the 2 closing entries for Kelly Consulting would be shown in the next slide. So remember, we have to close revenues and expenses, and we have to close dividends. So after the closing entries are posted, Kelly Consulting Ledgers has the following characteristics. The balance of retained earnings would be $12,300, should agree with the amount reported on the statement of stockholders' equity. The revenues, expenses, and dividends account will have 0 balance because these are temporary accounts that are going to be closed. The closing entries are normally identified in the ledger as closing. In addition, a line is often inserted in both balance columns after a closing entry is posted. This separates next period revenue, expenses, and dividends transactions from those of the current period. And now we are ready for the next month, next year. You reset the values for revenues, expense, and dividends. And now we have our journal entries, and remember it's 2 closing entries, one for revenues and expenses, you close them in retained earnings, and the second one in for dividends, where you credit dividends and you debit the retained earnings. Once you're done with the closing entries, you are ready to prepare the post-closing trial balance. And this is prepared after the closing entries have been posted. The purpose is to verify that the ledger is in balance at the beginning of the next period. So we're ready to start a clean form of financial statements in the next cycle. The accounts and amounts in the post-closing trial balance should agree exactly with the accounts and amounts listed on the balance sheet at the end of the period. The balances shown in the post-closing trial balance are taken from the ending balance in the ledger shown in Exhibit 18, which will be in the coming couple of slides. So you can see here that we have the post-closing trial balance. We have all the list of assets, liabilities, and equity. No revenues, no expenses, no dividends, because these are temporary accounts that have been closed. And again, the totals should match. And then in this Exhibit 18, we have a list of all our accounts, starting with cash, accounts receivable, supplies, prepaid rent, prepaid insurance, and all of these, they have their own balances. We also have office equipment, accumulated depreciation, accounts payable, salaries payable, unearned fees, common stock, and finally, retained earnings. And then all the other accounts or temporary accounts should have a balance of 0. So dividends, fees earned, salaries expense, rent expense, supplies expense, depreciation expense, insurance expense, and miscellaneous expense. You can tell that all of them, they have 0 balance. So why is the accrual basis of accounting required by the generally accepted accounting principle? This is very important for us to understand that we are required to follow the accrual basis, not the cash basis. So all what we care about is whether the revenue has been earned. It doesn't matter whether cash has been received or not. The same thing for expenses. Whether expenses were incurred, it doesn't matter whether we paid the expense or not. So to understand why the accrual basis of accounting is required, it's first necessary to consider the alternatives. The primary alternative to GAAP is the cash basis of accounting, which records transactions only when cash is received or paid. Remember, this is not typically accepted by GAAP. The accrual basis of accounting uses the revenue and expenses recognition principle to record revenues and expenses. So under revenue recognition, revenues are recorded when earned, which is when the service has been performed or product has been delivered to customers. No matter cash is involved or not. As long as we have a promise to get the cash or we already got the cash, then this is a revenue. Under the expense recognition principle, the expenses incurred in generating revenue are recorded in the same period as the related revenue. So here we have a comparison between the accrual basis and the cash basis using for an income statement. You can see the net income would be different. So in this case, the fees earned were all received in cash, so they were the same. Same thing for wages, but for rent expense, actually under the accrual basis, we only incurred 800. But it's actually the same here, I'm sorry. The supplies are the ones that are different because here we paid for the supplies. So supplies is considered to be an expense when we pay for it in total. That's under the cash basis. On the accrual basis, it's only recorded when it's used. Utilities are the same, miscellaneous expenses are the same. So the only difference in this case was the amount of supplies. For another example here, we have the fees earned were different because some of the fees that we earned were not received. So they were just in the form of accounts receivable. So under the cash basis, we only record the fees earned in the form of cash. Same thing for the rent revenue. Only the part that we earned would be recorded, but under the cash basis, all the cash received is going to be considered revenue. If you look at the expenses, again, the same approach. Like maybe wages expense is slightly different. Insurance expense is also different. We only record the things under the accrual basis that we incurred, but under the cash basis, anything that we pay related to the expenses would be recorded in total, which would definitely affect the value of net income at the very end. So under the accrual basis here, you show that there's net income, but under the cash basis, it shows net loss because the expenses were much more because we paid more in advance. Here we also have a comparison for the interpretation between cash basis and accrual basis. So Net Solutions is profitable and rapidly expanding under the accrual basis, but under the cash basis, you can see that Net Solutions is in trouble with declining revenues and increasing expenses, which generated a net loss. This suggests that Net Solutions may not be able to continue as a viable company without significant operational changes. However, this is not very accurate because, again, you're including expenses that are actually related to future periods. And because of that, your amount of expenses, you can see, are much higher compared to the accrual basis. In the accrual basis, you only record expenses that are related to the period. And that would show us a fair amount of net income compared to the cash basis. In the last part of this chapter, we're going to go over some analysis for decision making, and we're going to get to see the working capital and current ratio. These are important measures for analysis, so make sure that you understand them. I would consider this is the easiest form of analysis an accountant can do, and any person in business should understand. So the ability to convert assets into cash is called liquidity, while the ability of the business to pay its debts is called solvency. Liquidity and solvency are somehow related, but liquidity is basically your ability to generate cash by converting your assets into cash. Solvency is your ability to pay your debt. There are two financial measures for evaluating a business: short-term liquidity and solvency, and these are called working capital and the current ratio. So working capital is basically the difference between current assets and current liabilities. And pay attention to that. It's not the total assets, it's only the current assets, the short-term assets. Assets are already cash or going to be converted or used within a period that is less than a year. Current liabilities, these are obligations they have to pay within a period less than a year. So the difference between these two, we call them the working capital. So current assets are more liquid than long-term assets because they can be more readily turned into cash to meet short-term obligations. Therefore, an increase in a company's current assets increases or improves its liquidity because these assets are available for uses other than paying current liabilities. Of course, a positive working capital is favorable. This implies that a business is able to pay its current liabilities and it's solvent. An increase in working capital increases or improves the company's short-term solvency. For our example, for Net Solutions, you can see that the current assets minus the current liabilities was a positive number, which is really good news for the business. The current ratio is very similar. We use the same measures, current assets and current liabilities, but instead of subtracting them, we actually divide them by each other. So it's another measure or another form of expressing the relationship between current assets and current liabilities. So in our example here, we divided current assets by current liabilities, and the rounded value was 5.6, which shows that for every dollar of short-term liabilities, there are $5.60 available to pay these short debts using current assets. So the current ratio is more useful than working capital in making comparisons across companies or within the industry. Why? Because it's a relative measure, but if you go back to the working capital and we see the 6,000, you cannot really tell if 6,000 is a big number or small number. It depends on the size of the business. But using the current ratio, 5.6, you can tell that this is a very good number because they have almost 6 times assets that can cover their liabilities. So by this, I conclude Chapter 4. I wish you all the best, and I'll see you again in Chapter 5.